everyone, hello and namaste. I am Akshat Malhotra, your teacher for this course. Thank you so much for watching. Till now, we've covered everything that is for you to learn on money, from the basics of savings and investing to budgeting, asset classes, diversification, financial planning, taxes, and even how can you pick up the right mutual funds to invest in. In this module, we'll focus on insurances, something that I've honestly seen people make the biggest mistakes. And therefore, it's my humble request to please watch carefully and make sure you do not repeat them. All the best. Let's talk about life insurance. Now, for a second, not trying to spread negativity or any sort of that thing, but just for a minute, close your eyes. Close your eyes and think of a time that you're not here. You're not here. What will happen to your family? How will they take care of their financial needs? How will they take care of all the future financial goals that you had as a family together planned? It's going to be tough, right? And once again, I'm sorry to take you through this activity, but the purpose of this activity is to help you visualize that we don't know where life takes us. And so it's very important for all of us to have a life insurance. If we are the primary or even the secondary bread earner of the family, and our family is dependent on our salary, on our earnings, then we must have a life insurance. Right? You don't have a life insurance? I too like to live life dangerously. I like to live life at the edge of the cliff, as they say. But you get the point. It's very mandatory to have a life insurance, right? Now further, let's study what are the various types of life insurances that are available to us. Number one is the endowment plans. Now, typically, just for our understanding, let's understand there are two types of benefits that every insurance plan can offer us. One is a maturity benefit, which means that we pay the premiums, and at the end of the time, at the end of the maturity period, as they say, once we've paid all our premiums, we get some money back. So that's our maturity benefit. That's called maturity benefit. On the other hand, a death benefit, right? In case something happens to us, then our family gets that money. So that is called as death benefit or the sum assured, right? So maturity benefit and death benefit, these are the two benefits that every insurance policy should offer. Now, endowment plans are the plans in which you have a fixed amount on maturity. I mean, from day one, when you start paying the premiums, you'll know that after paying the premiums for about 20 years, 30 years, whatever plan you choose, you'll get this X amount back. And also at the same time, you get a guarantee. You know that in case something happens to us, then our family will get this amount of sum assured as death benefit. So endowment plans are plans in which our fixed, our maturity amount, maturity benefit as well as the death benefit, both are fixed on the day we buy the plan. The next ones are ULIP plans, unit linked insurance plans. Now these are the plans that once again have a maturity benefit as well as death benefit. But in this case, the maturity benefit is not a fixed amount. Just like the mutual funds work, and now you know how mutual funds work, the ULIP plan further invests your money into these funds, and whatever is the amount based on the market conditions is prevalent at the time of your maturity, whatever wealth that plan has been able to create, you get that money back. Okay, so ULIP plans are plans in which you have a maturity benefit, but it's not fixed, it is market linked. So whatever premiums you pay, there is some cost that is subtracted for covering your insurances, and all the remaining money gets invested into the markets. Clear? And then the sum assured obviously is fixed, the death benefit is fixed. From day one, you know that you will get this amount of money back. And then comes the term plan. Term plan is a plan in which you have a death benefit promised, but there is no maturity benefit. Now, I know it might sound very funny, death benefit, but yes, these are the plans in which you keep on paying premium, but you do not get any money back. All you get is a guaranteed sum assured, which is generally pretty high. You get that guaranteed sum assured. In case something happens to us, your family would get that money. So that's the third type of plan. Now, which one should we choose and which one should we go for? Quickly tell me, do you have any plan with you right now? Do you hold a life insurance? Put it in the discussion forum. Do you have any life insurance? It could be a ULIP plan, it could be an endowment plan. And if you have one, put it down how much premium you are paying and how much is the sum assured value. And for the purpose of that, I've opened one here. So let me show you how a ULIP plan typically looks like. So opened up an ICICI Prudential ULIP plan. We have no affiliations with ICICI, disclaimer, but I just used it for, the UI looks clean for me to explain. So that's why. So let's say you're investing 30,000 rupees in a ULIP plan yearly, once in a year for 30 years. For the next 30 years, you're going to pay 30,000 rupees every year. And here you say that you have a life cover of 3 lakh rupees. So that's the death benefit, that in case anything happens to us, we're going to get 3 lakh rupees. And then if everything goes smooth, if nothing happens to us, by God's grace, we live throughout that period, then at the maturity time, we get about 28.87, 29 lakh rupees. Good amount, pretty huge amount, right? 30,000, just we're paying 30,000 for 30 years, in total 9 lakhs, and we're getting 30 lakh rupees. Very attractive, right? But before that, let me ask you a question. And I'm sure if you guys have any ULIP plan right now, you could look at your policy documents, find that out. The life cover, the death benefit of 3 lakhs that is being promised in this plan, do you think this is enough for your family to live their lives throughout without you? Let's assume that I'm 30 years of age. Then for the next 30, 40 years, which were my earning years, if I'm not there, do you think this 3 lakh rupees of amount is enough for them to live, to cover for all the earnings that I would have done if I was there? 3 lakh rupees? I'm sure the answer is no, right? So let's understand how much insurance do we actually need. Let me take you to a calculator, and the first step is, how much insurance do we actually need? Let's learn how to calculate the need of the insurance. Assuming our current age is 30 years, the current annual expenditure is 3,60,000. So what I mean to say by that is, I'm assuming that you're spending 30,000 rupees a month from your salary. So your annual expenditure adds up to 3,60,000 rupees. And all of us consider 60 years to be the retirement age, right? So the number of years to retire is 30, right? Current age is 30, retirement age 60, 60 minus 30, 30 years. So all in all, if I do nothing at all, no super calculations, 3,60,000, in case, let's say something happens to me today, if I, by chance I'm not there anymore, something happens to me, then my family needs a minimum of 3,60,000 into 30 years, right? We haven't considered an inflation rate, and there is a reason for that. I'll just cover that. But all in all, We need 3,60,000 rupees per year for the next 30 years. So that adds up to 1 crore and 8 lakh rupees. 1 crore and 8 lakh rupees, right? Now on top of that, let's say that I had taken some loans. I'd taken a loan of about 11.5 lakh rupees. I had some life goals that I had planned with my family, which amounted to be about 25 lakh rupees. I wanted to buy a car, house, prepare for my child's education. So all of those goals added up to about sum of 25 lakh rupees. And at the same time, I did make some investments worth 10 lakh rupees. So whatever investments I did, they're all added up and 10 lakh rupees of corpus is there. So now my the actual need of my family is 1 crore 8 lakh rupees, which they need to take care of the monthly expenditures, the 3,60,000 per year, plus the 11,50,000 of loans because somebody has to repay the loans that I have taken, plus the life goals that we've planned because, we don't want the life goals to get hampered if you're not there. We still want our family to achieve all of those things that they would have done with us. So if we add up all of these things and subtract the investments because that's the amount that we've already made, so they can take that amount and use that, the final comes to be 1 crore and 34 lakh rupees. So in case something happens to me today, my family needs 1 crore and 34 lakh rupees. My family needs 1 crore and 34 lakh rupees. The ULIP plan is offering me 3 lakh rupees. Are you observing the difference? 1 crore 34 lakhs is what we need. 3 lakhs is what we're getting from that ULIP plan. Not sufficient, right? Not sufficient at all. And just for the purpose, let's say if I need 1 crore and 30 lakh rupees from that ULIP plan, let's see how much do we need to invest. Oh, that's too much. Okay, close enough. So if I invest 1.5 lakh rupees yearly in a ULIP plan for the next 30 years, I will then be able to make 1.47 crores. If I buy an insurance of 1,50,000 rupees, how am I going to invest? How am I going to invest my money? Right? On the other hand, let's look at, so now that you know that 1 crore 34 lakhs is the basic thing we need, and ULIP plans can't promise that. I mean, to buy that in a ULIP plan, I'll need a lot of money, a lot of premium. So I cannot go with the ULIP plan, right? So which one should I go for? And I know this might sound funny to you, but the only plan that you ever need is a term insurance plan and nothing else. Yes, all you need is a term insurance plan, no endowments, no ULIP, no XYZ plans, just one term life insurance plan. And why so? Let's look at that. A term life insurance, once again, just looking up an ICICI Prudential calculator, no affiliations, please remember. So we need 1.34 crores on an, by that calculation. And what I've taken here is, let's say, we want our family to live absolutely relaxed, tension free. So what if I take a policy of 2 crore rupees? So if I take a life cover of 2 crore rupees, you see here, I pay just 19,924 rupees. In a ULIP plan, I was paying 1.5 lakh rupees to get 1.5 crore rupees. In a term insurance plan, I'm paying just 19,924, 20,000 rupees to get a life cover of 2 crore rupees. 2 crore rupees. Make sense? Make sense? Now, you'll be like, Akshat, but in the ULIP plan, you said we will get it back for sure, right? We are having a fixed maturity. I mean, we are having a maturity, promised amount at maturity. Though it's not fixed, but this calculator does show that we're going to get about, in that 30,000 example, we want to get about 30 lakh rupees. But here in the purpose of term plan, we're not going to get anything back. We're just investing, you're just putting money throughout our life and not really getting anything back. Agreed, agreed. And that's where this basic concept comes. What is insurance? Insurance is not investment. Insurance is not investment. Write it down in caps. Insurance is not investment. Just like we buy a mobile phone to make calls, we use a laptop to surf the net, we buy an insurance to protect ourselves. We do not buy insurance to get returns. For that, we have mutual funds, fixed deposit, PPF schemes, hundreds of other schemes. We buy an insurance to protect ourselves. We do not expect the insurance to give us returns. Getting my point? And that's where the problem comes, because we get lured by these so many different sort of schemes that we forget what we need. We expect returns from our insurance as well. And that's where we make the problem. That's where we make the mistake. Insurance is the most missold product, if I may use that word, because we as people don't realize what insurance is. So let's look at this example here to further answer the question that Akshat, ULIP policy still gives me something back. Term insurance, I'm not getting anything back. Why should I buy that? So to answer that, I have a calculation. Let's consider this table here. Current age 30 years once again, right? So now you saw the endowment plan, ULIP plan, kind of the same. Endowment is another different, but ULIP plan for this calculation we've taken 30,000 rupees. We're paying for a period of 30 years. So how much we've paid in total? 9 lakh rupees. Now sum assured is 3 lakh rupees. And finally, the investment bonus is 28 lakhs, which is, approximately given here. Let's consider 30 lakh rupees, right? Let's consider 30 lakh rupees. So 30,000 I'm paying for the next 30 years, 9 lakh rupees I pay. And in the bonus investment value, in total, I get 30 lakh rupees. Happy? Sounds attractive. I'm very happy buying this product. On the other hand, term plan. For 20,000 rupees, if I pay for 30 years, in total, I just pay 6 lakh rupees. And against that, I get a sum assured of 2 crore rupees. 2 crore rupees. And if nothing happens to me, I get nothing back. I get nothing back. And now, to answer your question, yes, you would say here, Akshat, here I'm getting this 30 lakhs back. I'm not getting anything back. Okay. So you see the difference here, 30,000 and 20,000. 30,000 is what you're paying the premium for your ULIP, and 20,000 is what you're paying the premium for your term insurance. What's the difference? 10,000. So if you invest this 10,000 rupees into even an index mutual fund, now you know what an index mutual fund is, and you know that we can expect in a period of 30 years, we can expect a 15% rate of return. You've seen these calculations. So if we invest this difference for a period of 30 years, even in an index mutual fund, our total sum becomes 49,99,569 rupees. 50 lakh rupees. 50 lakh rupees. This does not only cover the 30 lakhs that we would have gotten from the ULIP, but also covers the premiums that we might have paid of these 6 lakh rupees in total with the term insurance. There you go. Plain simple. Plain simple. You've been able to manage the return that you wanted, the return. And that's the point. So all we need is a simple term life insurance plan with a regular pay option. And when I say a regular pay option, let me take you further. So now these days, the insurance companies have become smart. They're like, people have started to realize the importance of term insurance. And so let's try and give them some more options with term insurance. So yes, there also now comes a plan where, you can even get your premiums back for term insurance. But what's the flaw with those plans? Let me quickly walk you through that as well. So here you see that down here, I have some limited pay options. So the insurance agent tells me that Akshat, why do you want to pay for 30 years? Why do you want to pay for 30 years? You know, you're continuously paying 20 years for the next 30 years. Why don't you pay for just 10 years? If you pay for just 10 years, you're paying 42,000 right now. But in total, if you see, you're just paying 4,20,000 rupees. So that looks to be a better deal. You know, you save 1,80,000 altogether. Why do you want to continue paying for the 30 years? Who knows 20 years later you have a job or not, or you know what kind of a condition you are in. Okay. Point number 1. If you consider inflation in between, paying 20,000 every year, I'm actually paying lesser premium every year. Because the value of money is increasing, but I am paying the same premium. So which means 20,000 of today, 25 years, that'll be like peanuts. So I am in fact paying a decreasing premium every year, right? On the other hand, let's actually do some calculations again. Here is your regular pay versus the 10-year plan. So in the regular pay, as you see, we have 20,000 rupees is what we are paying per year. So in total, we pay 6 lakhs. In the 10-year plan, we're paying 42,000 something, rounded off to 43,000. So total of 4,30,000. And you're like, here, 1,70,000 rupees is extra, is what I'm paying in the regular pay. Once again, plain simple mathematics. 43 minus 20,000, 23,000. Now, if you invest this 23,000 once again into an index mutual fund for a period of 10 years, and if you're able to get 12% return, this sum adds up to 4,52,000 rupees. It covers the 1,70,000 of the opportunity cost that we could say. Triple the amount, right? Almost 2.5 times the amount. And let's say if this is just for 10 years, let's say if I continues remaining invested for 30 years, what would compounding make this amount go up to? 62 lakh rupees. 62 lakh rupees. Can you believe that? And that's the point. By taking money from you in the initial years, the insurance company is going to enjoy the magic of compounding. You are not. And so that's why treat it as any other random product. Treat insurance as any other random product. If today I tell you iPhone is 60,000 rupees, for example, but you pay me 90,000, will you do that? For the same plan? No, right? You'll still pay me 60,000. Then why do you want to pay upfront to the insurance company? It makes no sense at all. Getting my point? And so once again, the only insurance plan we need is a term insurance plan with a regular pay option. Which means pay throughout the policy term. Now, one more important point here. These days, the insurance plans have come like, why don't you cover yourself till 80 years, 85 years, 99 years as well? The probability of something happening to us at 80 years is much more than something happening to us at 60 years, right? Makes sense. Going back to the basics. Why do you need an insurance? To protect yourself. When do you need to protect yourself? During your earning years. When are your earning years? Till 60 years, max 65 years, or max 70 years. After 70 years, you might not be earning. And in fact, your children would be grown up. They can take care of their own needs. You've already done all your investments. You've made your financial goals. You've made your investments as per your goals. So you're on track to fulfill all those goals. So you don't really need to cover yourself till 80, 85 years. Because we need insurance at the time when we are the primary or the secondary bread earner of the family. At 60 years of age, we are no longer the primary or secondary bread earner of the family. Our children are grown up. They can take care of their own needs. 65, 70 years, we're done. And so when our family is no longer dependent on our earnings, on us, then why do we need the insurance for? What do we need the insurance for? So unnecessarily over covering ourselves, just for example, you see here, instead of 30, what if I put 50? The premium amount goes up from 19,000 something to 32,000 rupees. I will unnecessarily start paying 12,000 rupees every year from now on just to cover myself till 80 years. Now think of it. Put this 12,000 rupees into an index fund. Now you know the calculation. I'm sure you will be able to make in lakhs, right? And that's what you need to do. So once again, coming back to the basic, you need to cover yourself only during the years of life when you are the primary or the secondary bread earner of the family, when somebody is dependent on you. And once those years are over, you can relax, you can take a chill, right? So with that, I hope I have been able to explain you the concept of life insurance. Why is it important to have a life insurance? What's the only life insurance that you need? And even in that, what is the only type of plan you need? All you need is a term life insurance till 60, 65, or max to max 70 years of age. That's it. That's it. With a regular pay option. Cool? If you have any questions, please write them down. If you have any concerns, you have my email ID. Please drop me an email. But for God's sake, do not make a mistake while selecting your insurance product. Buying a wrong insurance product means you unnecessarily continue to pay the premium for your entire life and cannot reap the benefits of these products. Thank you once again for watching. I really hope you found it useful. Please don't forget to like, share, and subscribe to the channel. Put in all your questions in the comments. And yes, go there and let your friends know about this course, which is available absolutely for free. Make the most of your money.